All right, today we're going to peek under the hood of a pretty unique investment vehicle, the Divinity Long Short Fund. We're going to deconstruct its risk managed strategy and really figure out what makes it tick.
So let's kick things off with the big question this fund is trying to answer. How in the world can you set up your investments to make money not just when the market's going up, but also when it's going down? Getting your head around this is key to everything we're about to cover.
Here's our game plan. We'll start with what this kind of fund actually is, then dig into why a strategy like this even makes sense right now. After that, we'll get into the mechanics, run through the numbers, and finally figure out who this is really built for. Okay, first things first. To really get what this fund is about, you gotta understand the sandbox it plays in. It operates under a special framework called the Specialized Investment Fund, or SIF for short. Now, at the heart of this whole thing is the long-short strategy. Going long is what most of us are used to. You buy stock and you hope it goes up. Pretty simple. But going short is the exact opposite. You're essentially placing a bet that a stock's price is going to fall. The real magic here is that this fund is built to do both of those things at the very same time. So where does a SIF like Divinity fit into the big picture? Well, think of it as a hybrid. On one hand, you have your traditional mutual funds, highly regulated, super transparent. On the other, you have things like alternative investment funds, or AIFs, which offer a ton of flexibility but can come with higher risks. This SIF structure tries to give you the best of both worlds, the regulated safety of a mutual fund with the strategic freedom of an alternative. You know, even the fund's name tells you a story about its philosophy. Divinity is a mashup of divine for things like integrity and niti, which is an Indian concept for ethical strategy. It's all meant to signal an approach that's about more than just numbers. It's about responsible investing. Okay, so we know what it is. The next logical question has to be why? Why does a strategy like this make sense in today's market, and what problem is it really trying to solve for investors? Well, the whole reason for this boils down to a few major market headaches. First, stock valuations are frankly pretty high, and that's making the markets a lot more jumpy and volatile. This leads directly to the second point. Investors are getting more and more concerned about protecting themselves from a potential downturn. And as if that weren't enough, the traditional safe investments like bonds just aren't giving you much of a real return after you account for inflation. And all of that brings us to the core goal here, to achieve something called asymmetric returns. Now, it sounds complicated, but the idea is simple. It's not about trying to hit a home run when the market is booming. It's about capturing a healthy piece of that upside while, and this is the most important part, protecting your capital and softening the blow when the market inevitably corrects. It's all about making the investment journey a smoother, less stressful ride. It really brings to mind that legendary quote from Warren Buffett. Rule number 1, don't lose money. Rule number 2, never forget rule number 1. That pretty much perfectly sums up the defensive mindset here. It's about winning by not losing. All right, we've covered the what and the why. Now it's time to pop the hood and see how this engine is actually built. How do they construct the portfolio to make all this happen? As you can see, the portfolio is this really dynamic mix. The biggest slice, those strategic longs, that's the core of the portfolio, long-term holdings in quality companies. Then you have tactical longs, which are more like shorter-term bets on current market trends. Next are the tactical shorts. These are the defensive tools used to protect the portfolio or profit from falling prices. And there's always a chunk of cash on hand for stability and to pounce on new opportunities. This whole setup is described as having a dual portfolio advantage. A good way to think about it is like having a stable foundation with a flexible layer on top. The strategic portfolio is that solid foundation, built for long-term compounding. Then you have the tactical overlay, which can adapt to the market weather, adding or removing short positions and other trades to manage risk on the fly. Now that we've got a handle on the strategy, let's get into the practical stuff. Here's the essential fine print that any investor would need to know. First things first, the entry ticket. This isn't really a retail product. It's designed for qualified investors who are comfortable with more complex strategies. To get started, the minimum investment is 10 lakh rupees. Now, the fund does have an exit load, but it's really designed to encourage a longer-term mindset. For the first 6 months, you can actually redeem up to 10% of your investment completely fee-free. If you pull out more than that, there's a small 0.5% charge. But here's the kicker. After 6 months, there's no exit load at all. Taxation is handled on the investor's end, and it's actually pretty straightforward. The tax rate you pay just depends on how long you hold the investment. If you hold for less than a year, you pay the short-term capital gains rate.
hold for more than a year, and the long-term rate applies. Simple as that.
So after digging into the strategy and the numbers, we can pull it all together and answer the final question. Who is this fund actually designed for? So who is the ideal investor here? Well, it's definitely someone with a long-term outlook, someone who cares more about managing risk than chasing the absolute highest returns. They obviously need to be able to meet that 10-lock minimum, which usually means they're a more sophisticated or qualified investor. And almost always, they're making this kind of decision with the help of a financial advisor. And there is one last absolutely crucial rule to be aware of. This is really important fine print. To make a withdrawal, your total investment, and that's across all SIF strategies linked to your PAN, has to stay above that 10 lakh rupee minimum. If a redemption request would cause your balance to dip below that line, the request will be rejected. So you got to keep that in mind.
And that brings us to our final thought. We just picked apart one specific fund, but it really points to a much bigger trend, doesn't it? As markets get more and more complex, are these kinds of risk-managed strategies, the ones that blend both offense and defense, going to become the new normal for every serious investor out there? It's definitely something to think about.